Good evening. This is Cat at Tortoise Capital with a review of the weekend trading reports for June 22nd, 2019. The market is in bullish normal conditions. On an annual basis, using NDX 260, we are deeply overbought. Shorter term, using the 10-day NDX, we are at, near the higher end of neutral at 73 out of 100. In the market mosaic, price with respect to the 200-day moving average is green bullish at 6%, so we're 4% above the threshold for sideways markets. Slope of the 50 is yellow bearish, so there's been some weakness in the last 60 days. ADX green neutral at 21.3, non-trending, although the bulls are starting to take charge. The risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the boundary between risk on and risk off. That score is at 1.065, so we're well into risk on. We find the risk Z by taking that score and looking at the last 5,000 trading days for context. Find the average and standard deviation, and we compute that risk Z. It's at 0.62 standard deviations above the long-term average. You see a 90-day histogram here. When you have a turning point in the winter, it turns into the spring down here at more than 1 SD below average. This sets up really good long-term swing trades, which we saw the last couple weeks. And the volatility is kind of stabilizing right here. The last time it went into a sell-off, the time before that, a brief sell-off. So this is an area in which we should be cognizant of the risks to open profits. And you'll see that when I go through the slides later. Blend month rebalancing, you see the holdings for the month of July and the leading candidates based on closing prices on Friday, and then leaders in the other equity sectors as noted. Theoretical exposure of the market model in ETF2 is at 90%, with 9 out of the 10 global indexes above their 4-month moving average. Looking at some blended monthly rebalancing portfolios, everything's back into the buy with the exception of U.S. small caps. The key leaders gave back a little bit this week, although technology was pretty good. But Latin America and emerging markets had the big rebound this week. This may be as a function of concerns about the First World War potential and maybe some flight to quality, or that could just be a rebound from deeply oversold conditions. But in any case, there's been a significant turnaround in both of those areas for the 1 week and the 1 month. And we'll see that starting to see if that starts hitting the longer term performances here. ETF 32 portfolio, again, mostly everything on a buy signal with the exception of the Russell, commodities, China, and the energy sector. Now, energy, I'm expecting to see some gains because of the risks to oil and energy prices based on the increased tension with Iran. In the Dow 30, laggards are Intel, 3M, and Walgreens, Morgan, United Tech, and Goldman, but the key leaders generally had pretty good weeks with the exception of Disney. So I'd be looking at Microsoft, GE, and Visa as really strong candidates for continued momentum. They're outperformers, and then they had pretty good weeks. Nike's an interesting turnaround, as is Boeing, which has continued its rebound. Caterpillar also doing pretty well. In the sector spiders, about evenly split between buy and cash. Leaders, aerospace and defense, no surprise there. Insurance, home builders, and tech. Laggards generally in the energy and basic materials areas. Although I think we're starting to see some of that last minute rise in oil prices beginning to affect oil and gas exploration and equipment. ETF Max, these are the top 40 or so from the 500 in the database. Key leaders, gold, aerospace, and more gold down there. mean, you can just see the difference in the categorization of the holdings. So you have the COMEX Gold Trust only is +4 and 9, but the gold miners are at 7 and 24, and so those look like leveraged gold positions. So that's a thought for future asset allocation decisions. ETF2 lens on the indexes, only Russell is below its 4-month moving average. Everything else is on a buy. That's what gets us to 90 and 10. So despite the tension in the world, this was actually an improvement in the allocation model. The S&P at 78 is better than EFA. The globals at 67. Inside the U.S., it's technology, large caps, mid caps, small caps. Strength in discretionary and technology and energy lagging in the sector spiders. The U.S. generally above average except for excuse me, small cap value. The NASDAQ doing very well here in the green. Brazil has started to make its rebound felt. Top 30 or so in the ETF, in the ETF 30. Gold, the green and yellow, and then Brazil, green and red. Those are both very significant turnarounds. Early days yet for those recoveries. Dividend appreciation also not a bad way to play large caps, but also get paid some dividends. I guess interesting to note here, the low volatility in white and green is an area of potential concern on increased volatility. So the low volatility guys are losing right now. Shifting to the daily market health check. So the yellow shade, the big yellow shaded box is the last 30 days. So that's 10, 20, and 30. You can see, the highest high and the lowest low. The orange box is the 10-day look back period. And then this final little yellow box here is just the 1-day high and low. So I like to look at the mechanical entries for breakouts above the high and low of 1 day, of 10-day high and low, and 30-day high and low. And then these other red lines, because we're so near the top, these all represent support levels. That's 1 day, that's 4-day in the belly of this RL10, in the middle of the dragon. Then we have the bottom of the dragon and the RL90. The blue line represents what the opening price on Monday was. And one of the things that we've been noticing is that if you track the open on Monday, as long as price that week is above that, there's generally a bullish tendency. And that certainly helped us in these last 3 weeks. You can see in every case that the openings on Monday, then there was price follow through, and that gave us a long side orientation. We have the 200-day moving average down here around 277. The RL 270 slightly above. You can see the rising PSAR. The dragon peaked, bottomed out, and is now up near that peak. This is a natural place for topping action to occur. That it hit resistance here the last time near the all-time high, and so this hammer and then a sell-off on Friday going into the weekend looked problematic to me. In the MACD histogram, we had that long period of the fall, and then picked up the winter here as the MACD went below zero. So that was an effective guide in this season of the winter. And then we got spring, and that was a nice confirmation here and an early alert. And then summer with the follow through. So we've had 2 legs up. You can see it's starting to stall a little bit. And if it crosses its 5-period moving average here, then that's going to be the end of summer and then into the fall back to the zero line. So this is a natural place to see profit taking and defensive plays as people try to lock in the gains from this sell-off and then the rebound. Notice it was 2 legs down and it was 2 legs up, and here's that natural point inside the index. Very hard for indexes, especially the S&P, to just run away like a growth stock, and so we got to be able to respect the The short-term moves, these 1, 2, and 3-day moves, but then also kind of the 10-day and the 30-day oscillations within that larger context. The larger context is bullish market with the rising RL270, but at a natural respiratory pause location right there. All right, driving on. No signals in channeling and overreaction. The usual suspects in the 10-day max pain. I like looking at these as buying value on sale. We've seen those names before: United Tech, Walgreens, Disney. Those were the ones that were below their 4-month moving average back in the BMR chart. And so there's possibilities of buying quality on sale down there. The min pains, I don't usually talk about them much because I usually like looking for value baked into the cake. But these turn out to be the ones that are relative strength leaders. And again, you can see ExxonMobil has had a nice bump because of rising energy prices. Wheaton, no, that's WPM is Wheaton Precious Metals. Well, that's Wells Fargo. But Microsoft, Nike, IBM, United Health, those are all legitimate candidates for relative strength follow through if we get up markets from here. Only a handful of dojis, no other signals to speak of. Only United Tech is a tests out well on the auto framer. Lots of good frog quality numbers because of that declining volatility. That actually makes frog numbers increase, so that gives us reasons to use that system more on the intradays to get started. So breakouts in Chevron, Walmart just quietly getting it done right here. So a breakout on 10-day, 1 month, 3 month, and 6 month look back periods. Big breakout here in ExxonMobil on the 1-day and 10-day, and then micro breakouts here on Nike and Caterpillar. So those are the ones that broke through that resistance level that I talked about earlier. So there's no resistance overhead on those, so there's room for that buying pressure to continue for those playing continued momentum. In the ETF 30, again, a handful of dojis, only EFA right now testing out well in the auto framer. A good number of fraud quality numbers, plenty of volatile ones to choose from. So oil, metals and mining, Brazil, the triple Dow, all of those showing significant price volatility, which favors that short-term action. The only breakouts really, gold made nice multi-time period breakouts, and oil on the 10-day breakout. Pinch and stretch, lots of things have advanced beyond their Bollinger Band mean because of that rebound that we saw in the market, which it sold off and then it had a sharp reversal. Now we're seeing lots of things well beyond their Bollinger Band mean. The most negative Z stretches, just a handful. Most expanded pinch boxes in the green, these are ones that where the river is exceptionally wide, so gold is on a 4 sigma spread right now. These are all the super pinches. These are the cases where it's a combination of very compressed pinch box and all of the regression lines, the 10, 30, 90, and 270, have all collapsed together. So everybody in multiple time frames is agreeing that current prices are fair and the lack of volatility. That sets up a potential for traders to begin to start moving that in either direction. So I play that as a bi-directional breakout with room for possible expansions. So I study the size of those normal expansions from quiet areas, and then that gives me an estimate of what that first move out of the congestion could be. So I'm especially going to be looking at EWW Mexico, EZA South America, EWP Spain, coal is KOL. So plenty of things to choose from. Just a couple test out well on the auto framer. Dow, the EFA index, and United Tech. Regression line fractal framework, the top shelf, these are the ones that are deeply discounted value plays. There's Brazil, still plenty of room. It's and Mexico. And the bottom shelf in the red, these are the ones that are the most advanced above their own RL270. So these are relative strength leaders essentially. So again, you see strength there in Microsoft, gold miners, treasuries. I normally look at these as ones where I want to, if I've got positions in there with open gains, I want to make sure that, especially at a logical turning point like this one, that I've locked in those gains. Daily squeezes, we've seen some compressed volatility the last 2 days. And so these are ones where if we use the daily range as the risk and we get a breakout out of Friday's ranges, then if it just moves a range stat, then we get really favorable large size moves. So these are like 1 day compressed springs ready to break in either direction. Symbols that are noticeable: IBM, Microsoft, Pepsi, the the S&P 500 is in that position. So that actually means the market is poised for that kind of breakout. So would not be surprised to see sharp moves on Monday with some headlines. Four Seasons of MACD. Here's just an example of catching Goldman. I describe how I like getting things early in the spring or very late in the winter. So Goldman is at the lowest, earliest in the summer, and so Goldman actually gave us an earlier play where we get the big sell-off, then the RLXD, and then if we use that as the risk with an entry here, we're still in really good shape, and now we can use the bottom of the dragon or the PSAR as our trailing stop. You might even use a 2-day low, and that's kind of how you use the Four Seasons to quickly get you into those parts of the market in the cycle of breathing up and down that you get to help focus in on the part of the curve that you like the best. What part feels best for you? Where do you trade the best? I like this gains, sharp sell-off, recovery with an RLXD entry, and then manage that trade back to longer-term fair value. ADX is very strong trends in treasuries, and that. So if you've got gains in treasuries, having a 3 sigma strength of trend says we're probably closer to the end rather than the beginning. That's not a signal to sell. It's a signal to ensure that your stop is where you want it and that you've decided how much of that profit to preserve. The lack of trends are down here in the red, so these are extremely sideways or choppy. I like that Brazil is still early in its trendingness down here. Nice move in the S&P, but now you see that 2-day sell-off. It's a 1 sigma stretch above the long-term average. You can see that percent stretch above the 200-day is peaking at a place where it sold off the last 2 times it was there. It had 2 sharp sell-offs, but we're still not overextended yet. So we've got 2 legs up. A third leg is certainly possible, but notice that we got a falling hammer or falling star right there. Final chart, the river rolled over, 2 legs down, sharp recovery, now resting on the top of the river. The 90 is back in the middle of the river, so there's still room for another leg to continue. I mean, the last time it was here, it was right there, and you can see there was still plenty of room for it to go. So there's still more room ahead. But the 30 is kind of well valued, and the 10 is already kind of extended. So this is one that I'm cautiously optimistic to the upside, but I want to make sure that I'm locking in gains that were made along the way of this very nice leg up. Okay, that's everything from Ken at Tortoise Capital. Keep your risk measured and your powder dry.